This is not speculation. This happened. Over 18 months, China executed the largest coordinated exit from U.S. Treasuries in modern history. $688 billion, liquidated at a loss. A loss Beijing will never acknowledge, because doing so would admit that the foundational assumption behind 4 decades of dollar reserve accumulation has irreversibly broken. This wasn't rebalancing. This wasn't currency intervention. This was an exit, permanent, strategic, and deliberate. They knew they'd lose money. They did it anyway. By the end of this video, you'll understand exactly why a sovereign nation chose to absorb billions in losses to escape the Treasury market, and what this signals about the future of your own financial exposure. If you want to understand what's actually moving beneath the surface of global markets, subscribe now and turn on notifications. The signal most people missed came in September, not from Beijing, from Belgium. Euroclear, the settlement system that handles a significant portion of offshore treasury custody, reported an unusual pattern in its monthly clearing data. Redemptions from accounts linked to Asian sovereign entities spiked by 300% above the rolling average. The public explanation, when one was offered at all, pointed to routine portfolio adjustments. But redemptions don't spike 300% during routine adjustments. Redemptions spike 300% when someone is trying to get out before the door closes. I'm going to walk you through exactly what happened. I'll show you how China's treasury position was constructed, why it couldn't be unwound quietly, what the real loss calculation looks like when you account for duration and yield curve dislocation, and why the mechanics of this exit tell us something far more important than the headline number. By the end of this, you'll understand not just what China did, but what it signals about the future of dollar hegemony and your own exposure to a system that is beginning to fragment. For context, I've spent years watching sovereign flows, tracking custody data from the Federal Reserve's TIC reports, monitoring the spread behavior in off-the-run treasuries, and building models for how large holders actually move size in markets that weren't designed for exits of this magnitude. What I'm describing isn't theory, it's plumbing. It's how the system actually works when the participants everyone assumes will always be there decide to leave. Let me explain one concept that's essential to understanding this. When we talk about China holding treasuries, most people imagine a vault somewhere with bonds in it. That's not how it works. China's treasury holdings exist as electronic entries in custodial accounts, primarily held at the Federal Reserve Bank of New York in a system called the Treasury International Capital framework. These aren't physical assets, they're claims. And claims, unlike assets, depend entirely on the continued willingness and ability of the counterparty to honor them. When you hold a treasury, you're not holding a thing. You're holding a promise, and promises, in sovereign finance, are only as good as the political and economic alignment between the parties. Now, the official story you'll hear goes something like this. China reduced its treasury holdings as part of a broader diversification strategy. The People's Bank of China, like all central banks, periodically rebalances its reserve portfolio to optimize yield, manage currency exposure, and maintain liquidity. The reduction in treasury holdings was offset by increases in gold, euro-denominated assets, and bilateral currency arrangements. Nothing unusual, nothing to see. That's not what actually happened. What actually happened requires understanding how China accumulated this position in the first place. Starting in the early 2000s, China ran persistent current account surpluses with the United States. Dollars flowed into China through trade. Those dollars had to go somewhere. Parking them in treasuries accomplished 3 goals. It recycled the surplus back into dollar assets, which supported the yuan's peg to the dollar. It earned yield, turning dead reserves into productive capital. And it created a form of financial entanglement that, in theory, made both sides reluctant to destabilize the relationship. If China held trillions in treasuries, it had a vested interest in their value. If the US owed trillions to China, it had a vested interest in maintaining access to that capital. Mutual dependency, mutual deterrence. By 2013, China's treasury holdings peaked at roughly $1.3 trillion. That number represented years of accumulated surpluses, years of implicit trust in the dollar system, and years of assumption that the US would never weaponize its currency against a major creditor. Here's the critical point. That assumption didn't break overnight. It broke in stages, and each stage made the exit more expensive. Stage 1 was the 2018 trade war. Tariffs disrupted the trade flows that had been generating the dollar surpluses in the first place. China's current account began to shrink. The recycling mechanism that had been feeding treasury demand started to slow. This didn't require China to sell. It just meant China stopped buying as aggressively. Stage 2 was the pandemic response. In 2020 and 2021, the Federal Reserve expanded its balance sheet by over $4 trillion. Treasury yields collapsed as the Fed absorbed supply. China's existing holdings, purchased at higher yields, were now sitting in a market where new issuance paid almost nothing. The carry on those positions turned negative when adjusted for the yuan's appreciation. China wasn't losing money in nominal terms. But in real terms, in terms of what those reserves could actually purchase, the erosion had begun. Stage 3 was the Russia precedent. In February 2022, the US and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. This wasn't a sanction on trade. This was a sanction on reserves, on the sovereign wealth that Russia had accumulated over decades and parked in the same custodial systems China was using. The message was unambiguous. If you hold dollar assets in institutions subject to US jurisdiction, those assets can be frozen, seized, or immobilized at will. Stay with me, because this is where the calculation changes. Before February 2022, China's Treasury holdings were an asset with yield risk and duration risk, but no confiscation risk. After February 2022, every dollar held in Western custody carried a new variable. Call it jurisdiction risk, call it sanction risk, call it political risk. The label doesn't matter. What matters is that China's risk management framework had to incorporate a scenario it had previously assigned near zero probability. The scenario where the US simply decides those assets no longer belong to you. Now, a rational actor facing this new risk has limited options. Option 1, do nothing and hope the scenario never materializes. Option 2, hedge the risk through financial instruments, which is nearly impossible at sovereign scale. Option 3, reduce the exposure. China chose option 3. But here's the problem with reducing a $1 trillion position in any market. You can't do it quietly, you can't do it quickly, and you can't do it without moving the price against yourself. This is where the mechanics become critical. Treasuries trade in a two-tiered market. The primary market, where new securities are issued through auctions, and the secondary market, where existing securities change hands between dealers and investors. China's holdings were in the secondary market. To exit, China had to sell existing bonds to dealers who would then find other buyers or hold the inventory themselves. Dealers don't hold unlimited inventory. They have balance sheet constraints, capital requirements, and risk limits. When a sovereign-sized seller appears, dealers don't absorb that flow at current prices. They widen their bid-ask spreads. They lower their bids. They protect themselves from being caught holding a depreciating asset. The math works like this. In a normal market, 10-year Treasury bid-ask spreads run about 1 to 2 basis points. That sounds tiny, but on a $100 million trade, 1 basis point is $10,000 in transaction cost. Now scale that to $100 billion. 1 basis point becomes $10 million. And when you're selling $600 billion, and your selling pressure is widening, spreads to 5 or 10 basis points, and you're doing it over months, while the Fed is simultaneously raising rates and bond prices are falling, the cumulative friction becomes enormous. But transaction costs were the smaller problem. The larger problem was duration. Duration measures how sensitive a bond's price is to changes in interest rates. A 10-year Treasury has roughly 8 years of duration. That means if yields rise by 1 percentage point, the bond's price falls by approximately 8%. When China accumulated its position, 10-year yields were in the 1.5% to 3% range. By the time China accelerated its selling in 2023 and 2024, yields had risen to 4.5%, even 5% on some days. Let me walk through what that means in dollar terms. If China held $500 billion in 10-year equivalents and yields rose by 200 basis points during the exit window, the mark-to-market loss on duration alone would be roughly $80 billion. That's before transaction costs, before spread widening, before the opportunity cost of not being invested in assets that were actually appreciating. This is where the math breaks. Because China wasn't selling into a static market. China was selling into a market where the largest buyer of the past decade, the Federal Reserve, had become a seller. Quantitative tightening meant the Fed was letting its Treasury holdings roll off, adding supply to a market that was already struggling to absorb it. China was competing with the Fed to find buyers. The analogy I use is a stadium exit. Normally, when a game ends, everyone files out through multiple doors, slow but orderly. Now imagine the main doors are locked and everyone is trying to exit through a single gate, and halfway through someone yells fire. That's not a metaphor for panic, it's a metaphor for reduced liquidity meeting concentrated flow. And here's the feedback loop. As China sold, prices fell. As prices fell, China's remaining holdings lost value. As the holdings lost value, the incentive to sell before losing more increased. Each sale made the next sale more urgent and more expensive. This is what nonlinear failure looks like. It's not a smooth decline, it's a cascade. Now, there are two realities operating simultaneously in Treasury markets right now. The first is the price reality. Treasury prices reflect supply and demand in the secondary market, expectations for inflation and growth, and the Fed's policy path. By those measures, Treasuries are functioning, auctions are clearing, yields are elevated but not disorderly. The second is the structural reality. The marginal buyer base for Treasuries is changing. Foreign official holders, which means central banks and sovereign wealth funds, have reduced their share of outstanding treasuries from over 40% a decade ago to under 30% today. That share is being replaced by domestic buyers, primarily money market funds, banks, and households, who have different price sensitivity and different holding horizons. These two realities haven't collided yet, but they will, because the structural reality determines how the price reality responds to stress. If the next Treasury buyer is a price-sensitive hedge fund instead of a price-insensitive central bank, then the next liquidity event won't look like 2020, when the Fed stepped in and everyone calmed down. It will look like October 2023, when yields spiked 50 basis points in 2 weeks because there simply weren't enough buyers at the prevailing price. So let me give you 3 outcomes, and let me be clear that I'm not predicting any of them. I'm describing the probability space. Outcome 1. The Treasury market stabilizes through some combination of Fed intervention, regulatory relief for bank Treasury holdings, and a return of foreign buyers. Yields find an equilibrium. China's exit is absorbed. The system adapts. This is the fantasy outcome. Not because it's impossible, but because it requires every variable to break favorably. I'd assign this maybe a 15% probability. Outcome 2. A liquidity event forces the Fed to restart quantitative easing while simultaneously raising rates to fight inflation. The contradiction becomes explicit. The dollar loses reserve credibility. Foreign holders accelerate their exits. This is the chaotic outcome. It's not a controlled demolition. It's a fire sale. 20% probability, heavily backloaded into the next 3 to 5 years. Outcome 3, the most likely path. Managed decline. The Fed and Treasury quietly coordinate to absorb supply. The deficit continues to expand. Inflation runs persistently above target, eroding the real value of outstanding debt. Foreign holders reduce exposure gradually, not catastrophically. The dollar remains dominant but less hegemonic. Treasury yields stay elevated, repricing risk across every asset class. This isn't a crisis, it's a regime change. 65% probability. Now, what does this mean for you? Not as a trader, not as a speculator, as someone with savings, with a retirement account, with economic exposure to a system that is repricing in real time. The first thing is do not panic. Panic is what happens when you don't understand the mechanics. You now understand the mechanics. You know that China's exit wasn't random. It was strategic. You know that the losses were calculated and accepted. You know that the Treasury market is undergoing a structural shift that will take years, not months, to fully express. This is not a crash. This is a transition. The strategic mindset is this. Recognize that the risk-free rate is no longer risk-free. Treasury yields now include a term premium for duration risk, a credit premium for fiscal sustainability, and a jurisdiction premium for foreign holders. If you're holding long-duration bonds, you're being compensated for risk that you may not have signed up for. Here are the indicators I'm watching, and I'd suggest you watch them too. First, the TIC data, Treasury International Capital, published monthly by the Treasury Department, looks specifically at the line for China and for Belgium, which often serves as a custodial proxy for Asian holders. If holdings continue to decline, the exit is ongoing. Second, watch auction tail sizes. When a Treasury auction price is above the when-issued yield, that's called a tail. A large tail means demand was weaker than expected. Multiple large tails in succession signal buyer fatigue. Third, watch the spread between on-the-run and off-the-run Treasuries. On-the-run bonds are the most recently issued. Off-the-run bonds are older issues. In a healthy market, that spread is tight. When it widens, it means liquidity is concentrating, which is a stress signal. Fourth, watch gold. Not as an investment recommendation, as a signal. Central banks are buying gold at the fastest pace in decades. Gold doesn't pay interest. Gold costs money to store. The only reason to hold gold instead of treasuries is if you trust gold more than you trust promises. Fifth, watch the dollar index, but watch it against the yuan specifically. If the yuan is appreciating while China is selling treasuries, it means the capital is going somewhere else. If the yuan is depreciating, it means China is defending its currency with reserves that no longer include treasuries. Check these weekly, not daily. This is a slow motion process, and obsessing over daily moves will generate noise, not signal. Now, zoom out. What China did is not an isolated event. It's part of a broader fragmentation of the global monetary system that has been building for years, but accelerated dramatically after 2022. The petrodollar framework is weakening as Saudi Arabia accepts yuan for oil. The SWIFT network has a competitor in China's CIPS system. Central banks are diversifying reserves into gold, into bilateral arrangements, into anything that doesn't require trusting a single jurisdiction. This doesn't mean the dollar is collapsing. The dollar's share of global reserves has declined from over 70% to roughly 58% over 2 decades. That's not a collapse. That's erosion. But erosion, over time, changes the landscape. The question is not if the global monetary system is fragmenting. It is fragmenting. The question is not if the Treasury market is repricing for this new reality. It is repricing. The question is, How long the transition takes and how orderly it remains. $688 billion. That's not just a number, that's a statement. That's a sovereign nation with the world's second largest economy declaring, through its actions, that the cost of staying is now higher than the cost of leaving. That the implicit promise of safety and liquidity that anchored the Treasury market for decades is no longer implicit. It's contingent, and contingent promises get repriced. China took the loss. China absorbed the friction. China exited anyway. That tells you everything you need to know about what they see coming. The only question is whether you're paying attention.